Welcome and thank you everyone for joining us this morning. Now, this is the first major tax change that we have had since the Tax Cuts and Jobs Act in 2017. And you're going to hear us referencing the Tax Cuts and Jobs Act a bit during this presentation, because the One Big Beautiful Bill, or the OBBB, really makes a lot of changes that are from the Tax Cuts and Jobs Act, or they are extending provisions of the Tax Cuts and Jobs Act. Now, one thing I want to caution everybody on, there is a lot of misinformation out there on the internet right now, because there was two bills. There was the House version and there was the Senate version. The House version did not ultimately become law. The Senate version did. So there is a lot of discussion about changes that were going to happen with the House version that did not actually make it into the final law. So just keep that in mind. With the Senate version, it was very focused on economic growth, and it determined that a lot of tax provisions really needed to become permanent if we were going to see the greatest amount of growth within the economy. So that's what you're going to see a lot of these changes really being, is promoting that permanency within the tax laws. Now, there are a lot of small changes and some additions to the tax laws, and this can get complicated. So we are certainly willing and able to help with any sort of analysis to your tax situation. And we're going to have more on that after this presentation. So to start off, I'm going to talk about the individual tax changes that are really going to impact our individual taxpayers. The first change that was made was to make the 30 rate permanent. With the Tax Cuts and Jobs Act, they had reduced the top tax rate to 39.6%, from 39.6% to 37%. That was set to sunset in 2026. So we were going to see that 39.6% tax rate come back. What this bill does is extend and permanently extend that 37% tax bracket. It also adjusts some of the breakpoints within the different tax brackets, namely the 10%, 12%, and 22% tax brackets, and indexes them for inflation a little bit higher. So you're going to see some changes to the tax brackets, and what's going to happen in 2026 is going to be slightly different. But going forward, we now have that 37% high tax rate. That's permanent. Another thing they did was keep the higher standard deduction rates. So the Tax Cuts and Jobs Act had previously doubled the standard deduction while eliminating personal exemptions completely. That was also set to sunset in 2026, and we were going to get the lower standard deduction and personal exemptions back. So this really adjusts the standard deduction again, and this applies for 2025. These standard deduction rates that I show you there, those are for the 2025 tax year, and that's going to be continuing to increase with inflation each year. That's permanent. The personal exemptions are permanently gone. But one thing that they did introduce is this temporary senior deduction of $6,000 per taxpayer, and that's over the age of 65. Now, that only applies for 2026 through 2028. So there is this short period of time that you're going to have that senior deduction. But that means that if you are single, you get the $6,000. Married filing jointly, you get the $12,000. Now, there are phase-out limitations here. So once your modified adjusted gross income goes over $75,000 for single or $150,000 for married filing jointly, that is going to phase out. So certainly looking at income levels is going to become important going forward if you're in those brackets and if you're above age 65, to make sure that you're getting that additional deduction. Something else that the Big Beautiful Bill did was extend this personal casualty loss limitation. Essentially, you can only take losses for disaster losses. So what it did is basically permanently disallow all other personal casualty losses unless it relates to federally declared disasters. Now, something else that they introduced with the Tax Cuts and Jobs Act that the Big Beautiful Bill makes permanent is by disaster. Then it qualifies for the higher limitation of $500 with no adjusted gross income limitation. So there is a 10% adjusted gross income limitation that applies to casualty losses in federally declared disasters. But if it meets the definition of a qualified disaster, that 10% limitation goes away. Those laws are all permanent now going forward. One big beautiful bill introduced additional state declared disasters as part of the casualty losses. So now, even if it's not considered a federally declared disaster loss, it could be considered a state declared disaster loss, and that would still be deductible. The alternative minimum tax under the Tax Cuts and Jobs Act, the exemptions were increased. So a lot of taxpayers were not actually subject to that alternative minimum tax. And so since 2017, we really have not seen a great impact from the AMT. The big beautiful bill extends that. What was going to happen in 2026, we were going to get those lower exemptions and those lower thresholds, which would have meant that a lot of taxpayers would be subject to AMT. So now that we have those higher increased amounts that are adjusted for inflation going forward, and we have those higher phase-out thresholds that are adjusted for inflation going forward, it means that a lot of taxpayers are really going to avoid having the application of the AMT. This applies starting in 2026, which is the year that that phase-out was set to occur. The Tax Cuts and Jobs Act was going to end. Now, one little tweak that they did here, though, with the big beautiful bill is they introduced a higher phase-out percentage, which basically means that once you reach those income thresholds, that exemption phase-out is going to happen a little faster than it would have happened under the Tax Cuts and Jobs Act. So you may see some individuals impacted by that a little bit more than before. Another thing that I personally have been focused on for the past few years is our transfer taxes. That's our unified estate and gift taxes, as well as the generation skipping transfer taxes. Now, the Tax Cuts and Jobs Act had essentially doubled the exemption. It was $5 million permanently adjusted for inflation. Tax Cuts and Jobs Act extended that to $10 million per person adjusted for inflation to revert back to the $5 million plus inflation in 2026, which essentially meant that we had a lot of estate planning that was happening over the past few years to plan for that. This bill permanently increases it from $5 million to $15 million in 2026. So for 2025, we have an exemption amount of $13.99 million. In 2026, it will be $15 million, and then it will continue to increase for inflation over the years, which means that we're probably going to have around a $20 million exemption within the next 10 years. This means that a lot of individuals that previously were concerned that they might be subject to estate taxes or generation skipping transfer taxes when they pass away, they're now probably going to be sheltered. There's not a lot of people that are really going to be subject to this estate or GST tax unless you have, if you're single, over 15 million, or if you're married, then over 30 million. That means that a lot of planning is probably going to be centered around income taxing as opposed to estate tax planning. And certainly we can help with a lot of that. I know we put in place a lot of different structures as part of estate planning to try and minimize the impact of the decrease in 2026. So this is going to be a shift in planning to see how exactly we can structure things to get a better income tax result now. And certainly we can do that analysis for our clients. For itemized deductions, we now have a revamped state and local tax deduction. This was a big focus in the political world. A lot of states that have high income taxes were looking to increase that $10,000 limit. They were looking around $40,000. So what happened is they compromised. We have a $40,000 increase to the cap. It is for 2025 going forward through 2029. So it is a temporary increase, and it has income phase outs. So you're going to have that $500,000 income phase out, meaning once a taxpayer reaches $500,000, that $40,000 is going to decrease pretty significantly, pretty quickly until you get to about $600,000. Then it is going to stop at the $10,000 limit. So above $600,000 in income is really going to be the $10,000 again limit. Now that $500,000, that is for all taxpayers. taxpayers. That is not just single, it is married filing jointly as well. What this means is looking at where all your income sits and what state income taxes you're paying in different entities becomes important. Now, one thing I want to point out here is that there was a lot of discussion between the House version and when the Senate Finance Committee was looking at this as to whether that pass-through entity tax deduction was going to be limited as well. That did not make it into the final bill. So that pass-through entity tax is not capped. This is only for itemized deductions that SALT deduction is going to be capped. Our mortgage interest deduction, if you can remember back before Tax Cuts and Jobs Act, we had the $1 million mortgage loan cap that was going to be coming back. There was also interest on home equity lines up to $100,000 that was going to be deductible again. This bill extends the $750,000 cap, which came into play back in 2017, and it also permanently disallows interest on the home equity line $100,000 limit there. So that still remains non-deductible, and we keep that $750,000 limitation. One change that they did make, though, is that $750,000 limitation is now indexed for inflation. And they have also added in the ability to deduct mortgage insurance premiums as acquisition indebtedness loan interest. So you can get that deduction as part of the mortgage interest. They made some tweaks to the charitable contribution deduction. Prior law, you would have your charitable contributions that were deductible until you reach certain AGI limitations. That would be your 60% or 50%, 30%, 20%. There was temporary above the line deductions allowed during our COVID era relief time period that you would have seen $300 or $600 above the line along with the standard deduction, that deduction allowable there. So what this bill does is it introduces a deduction that those taxpayers that are taking the standard deduction up to $1,000 for single filers or $2,000 for married filing jointly. So that's a new addition here, and hopefully that helps our nonprofit clients when they are going out to get contributions and raise revenue, that taxpayers, even if they are claiming the standard deduction, they can still get a benefit for some of those charitable contributions. But one thing this bill does do is it introduces a new limit on charitable contributions. So not only do you have your AGI limitations applying, there is also an additional 0.5% limitation on the contribution base for the tax year. Taxpayers that itemize their deduction. Now, 0.5% isn't very much, but it is a revenue raiser in the bill. It is one of those little things that it'll chip away a little bit at the benefit of your itemized deductions there, your charitable contributions. And then I do have a note here, corporations, they did introduce a limit for corporations to 1% of the corporation's taxable income. That is the floor that you have to get over in order for the charitable contributions to be deductible. And then they do have that 10% of taxable income cap. So the deduction cannot exceed that amount. So they did some tweaks here with that charitable contribution deduction, though they didn't do substantial changes. Itemized deductions that are subject to the 2% limitation, they are now permanently non-deductible. This came about with the Tax Cuts and Jobs Act, previously able to deductions as long as the total amount exceeded 2% of your adjusted gross income. Those became non-deductible under Tax Cuts and Jobs Act, and they would have come back as deductible again in 2026. But this permanently disallows them. However, they did carve out a new unreimbursed educator expense. And that is carved out and it's now deductible beginning in 2026. So this means that a lot of our teachers, our educators, if they have unreimbursed educator expenses, which is generally equipment or supplementary materials that they can get a benefit from that. So keep that in mind. That is a benefit, especially if they itemize their deductions. The P's limitation we have not had to deal with since Tax and Jobs Act came into being. That was a 3% limitation on the excess of your adjusted gross income over an amount that they set, and that would have limited total itemized deductions. That is now permanently gone. They no longer have the P's limitation, but they did introduce a new limitation. And the limit is a little weird. It is 2/37 of the lesser of total itemized deductions, or the amount that a taxpayer's taxable income exceeds that 37% tax bracket cert number. In essence, that means that the maximum amount that you're going to see limited is approximately 5.4% of your total itemized deduction. So that is a new limitation that they have imposed here on itemized deductions. And that may just mean that some taxpayers are going to be taking the standard deduction instead of the itemized deductions. Now, they do carve out the 199A, that qualified business income deduction that Ben is going to talk about in a little bit. That is not going to be limited under this. Some credit changes, the child tax credit, this has certainly been talked about within Congress for a number of years. When Tax Cuts and Jobs Act came out, they increased the child tax credit because they were getting rid of the personal exemptions. So this was a way for parents to get a benefit from having their children and really providing a credit instead of a deduction. Now they doubled it. It was $2,000 under Tax Cuts and Jobs Act, and that was set to decrease to $1,000 in 2026. They managed in this bill to increase it further to $2,200 per child permanently, and that is indexed for inflation. That starts in 2025. So in 2025, we do have a higher child tax credit. The refundable portion is $1,400 per child. Again, that was put in place with the Tax Cuts and Jobs Act. That is permanently extended. And those modified adjusted gross income thresholds remain at the $200,000 for single or $400,000 for married filing jointly. And that $500 non-refundable credit for other dependents. So if they don't qualify for the child tax credit, you can still get a $500 credit for other dependents that you might have. That is maintained permanently, but it is not indexed for inflation. Now, I do have a note here about Social Security numbers and needing that to qualify. They have put that in place. That is a requirement going forward. That was put in place as part of the Tax Cuts and Jobs Act. They did stress this again, that a Social Security number for the child has to be included. And the taxpayer's Social Security number also has to be included in order to qualify for the credit. Another family-friendly credit is this child and dependent care credit. Again, this was made permanent. The increased amount, the $3,000 for one child or $6,000 for two or more. The credit rate was 35%. So 35% of total expenses up to that $3,000 or $6,000 limitation there. And that would decline to a minimum of 20% when the adjusted gross income of the taxpayer exceeded $43,000, which was pretty low. So this bill maintains this credit, but increases the credit rate to 50% from that 35%. So now starting for taxpayers is going to start at the 50% of total expenses. And that's going to phase down 1% for every $2,000 over the adjusted gross income of $15,000. Now you get to about 35% when you get to the $43,000 now. They have an additional limitation here. So once an adjusted gross income exceeds $75,000 for single or $150,000 for joint, it goes down to that 20% and then it stays there. So again, you still keep that minimum 20% for this credit. And what that means is you may have situations where parents will qualify for this dependent care credit, but they won't necessarily qualify for the child tax credit if their income far exceeds those limits. The adoption credit, they made a little bit of a tweak, not too much here. There is a tax credit for qualified adoption expenses that are incurred up to $17,280 per child. What this bill does is essentially include a refundable portion of that, which is up to $5,000. So not a great change, but it should provide a benefit for those that are looking to adopt children that are qualifying for this credit. They introduced a new contribution credit as part of this bill. Now, again, where they were tweaking all of the contribution deductions and they put in place limitations, they have now introduced a credit that you can use when you contribute to a scholarship granting organization. They're going to apply after 2027. So when we get to 2027, then thereafter, we will have this in place. I think they need a little bit of time to actually get this up and running, because the requirements to be a scholarship granting organization are really stringent. They're going to have the state have to elect to participate in the program. And then the state is going to have to gather the list of scholarship granting organizations. So to become a nonprofit is really going to have to segregate out the amounts that they're receiving for these qualified contributions. So there's going to be a little bit of paperwork there, a little bit of legwork that get this credit up and running, which is why they have it starting in 2027. To qualify as a scholarship granting organization, it has to be a 501c3 public charity. And so you're going to see, I think, whether it makes sense for them to become this scholarship granting organization. But once we have this up and running, taxpayers are able to contribute cash contributions to these organizations. The list is going to be provided to the IRS so you can identify granting organizations, and that credit amount is up to $1,700. So hopefully that, combined with the deduction for charitable contributions of $1,000 or $2,000, in addition to the standard deduction, that's really pushing a lot more taxpayers over to the standard deduction as opposed to itemized deductions. There were some Trump campaign promises that we saw, and one of those promises was the no tax on tips. I'm not sure that this fully comes to the standard of no tax on tips, because there are limits. It is an above the line deduction, so it is excluding those tips from income, but it's only up to $25,000. So $25,000 for qualified tips that are received by an individual. They have to be working in an occupation that customarily and regularly receives the tips in order to qualify for that deduction. It is allowed for both the W-2 employees, which the W-2 will specifically lay out the tips, and independent contractors. But it phases out once you get a modified adjusted gross income for single filers of $150,000 or $300,000 for those that are married filing jointly. So the individuals that will really benefit from this are the service workers that have your adjusted gross income below these limitations. But this is only a temporary deduction. It's not a permanent deduction. So it is available for 2025 through 2028. After that, we'll see if they put out on. But certainly it's a step in the right direction to exclude tips from taxable income. Promise was the no tax on overtime pay. Similar to the no tax on tips that they put in place, they did a temporary above the line deduction of up to $12,500 for single filers or $25,000 for joint returns. Again, you have those same income limitations of the $150,000 or $300,000 married filing jointly. That qualified overtime compensation, that does have to be separately reported on the W-2 or the 1099. So there will be some people that will qualify for this, but it is typically your non-exempt employees that get qualified overtime. Again, that is available 2025 through 2028. It is a temporary thing. They also introduced this new car loan interest deduction, and this is available for those who use the standard deduction and do not itemize their deduction. Again, it is a temporary deduction. It is 2025 through 2028, and it comes with a lot of strings attached. So the loan has to be obtained between those dates, 2025 through 2028. has to be a personal use vehicle. RVs do not qualify. Final assembly in the United States. And so I'm sure we're going to get a lot of guidance as to what this looks like. There's going to be reporting by the entities that provide those loans in order to indicate that it is qualified interest that does qualify for the deduction. And that deduction is capped at $10,000 per year. But they do have these income phase outs. So if you have $100,000 single or $200,000 married filing jointly modified adjusted gross income, the benefit of that $10,000 deduction is going to phase out over time. And finally, they introduced the Trump savings accounts. Now, this saw a little bit of a modification. In the House, it was just a normal savings account. In the Senate, they changed this so that it really is a traditional IRA, but it is a unique traditional IRA. Basically, contributions can be made to this type of savings account, traditional IRA, for children, for individuals that are under the age of 18. Now, you can't make contributions to this until 12 months after the enactment of the OBBB. So we now have a year, essentially 12 months, that we are waiting before we can actually get these up and running and get contributions made to these. But once you have them in place, you're able to contribute up to $5,000 per year. That is adjusted for inflation after 2027. And employers are also able to contribute up to $2,500 per year. Now that $5,000 cap does apply across all contributions, so keep that in mind. If you have a child that is born between January 1st, 2025 and December 31st, 2028, then that child, if you make $1,000 an election on your tax return to make $1,000 contribution to this IRA for the child, you're going to get $1,000 tax credit. So you're probably going to see a lot of these savings accounts coming into play for children that are born between that period of time. And basically, since this is a traditional IRA, you're not allowed to have the distributions while the child is a child still. Once they reach age 18, they can take distributions. However, because it is considered a traditional IRA, apply. So you can only take distributions to the extent that you are either going to pay a 10% penalty or you have qualified distributions, say for a first-time home or qualified education expenses. So it is an interesting savings account, and I'm sure we're going to get additional guidance on this to see how we can set these up. And the benefits that it just becomes one of those tools that you use in the toolbox when you're looking at saving for children in the future. So with that, I am going to turn it over to Ben, who is going to talk about the business provisions. And then after that, we'll take questions.
Yeah, thanks, Amy. And thanks again to everybody for joining us today. Something that we certainly learned several years back with the passing of the Tax Cuts and Jobs Act, which really changed everything for businesses and individuals, was that everyone was interested in what the new law meant to them and meant to their business. It meant to the businesses that they serve, if you're a service professional that's joining us today. And so we're hoping to help answer some of those questions today. But before I finish, I'm going to turn it back to Amy at the top of the hour to talk about something that we're doing and offering to our client base to help assess what this new law means to you and to your businesses. So with that, I'm going to spend the rest of my time today talking about some of the specific business provisions that we're seeing as most impactful within our client base right now. And the first of which is the qualified business income deduction. This was something that was brand new. We had not seen anything like it. It was brand new with the Tax Cuts and Jobs Act. And what it does is it provides a 20% deduction on a taxpayer's return. So typically an individual's tax return, they claim a 20% deduction against their qualified business income, which greatly lowers the effective rate of tax on individual on business income. Well, when the Tax Cuts and Jobs Act was passed, we saw a decrease in the ordinary income tax rate of 39.6% to 37%. So just a small decrease of the overall or the highest rate of tax for individuals. That rate of tax is what generally applies to business income for S corporations, partnerships, and sole proprietors, where the income is passed through to the owners who pay tax on their personal returns. This added deduction, this 20% qualified business income deduction, reduced that effective rate of tax from not just dropping from 39.6% to 37%, but when you factor in that you're only taxed on 80% of your qualified business income after applying the 20% deduction, the effective rate of tax drops to 29.6% on qualified business income. This was scheduled to go away. It was scheduled to sunset. And now we have a permanent extension of the 199 Cap A deduction. Now, one of the reasons that that was so important to see an extension of the 199A deduction is, if nothing else had occurred, something else that happened with the Tax Cuts and Jobs Act is that the corporate tax rate, the C corporation tax rate, dropped from 35% all the way down to 21%. That 21% rate for C corporations was made permanent with the Tax Cuts and Jobs Act, so it's not going away. If we saw a sunset of the 199A qualified business income deduction, we're going to have to start asking the question whether or not flow-through taxation continued to make sense for most of our businesses as it does today versus switching to a C corporation. This 199A deduction effectively maintained a benefit of flow-through taxation versus double taxation that exists with a C corporation. And so, without getting the numbers specifically, I'll just tell them to you high level. A C corporation is only taxed on 21%, where I just said the effective rate of tax is closer to 30% if you're eligible for the qualified business income deduction. So shouldn't I be a C corporation? Well, the downside of being a C corporation is those earnings that are in the C corp, once I want to take them out as an owner, they're taxed again as a dividend. And that's the double taxation, if you've heard that, from a C corporation versus a flow-through entity, an S corporation or a partnership or sole proprietor, where there's no second tax when I take the cash out of my business. I just pay it once, increases my basis, and I can take it out without tax. Once I pay the 21% rate in a C corporation and then distribute the earnings at the qualified dividend rate, the qualified dividend rate's 23.8%. The effective rate of tax on that income after applying double taxation is about 40% versus the 30% that we have after the 199A deduction. If the 199A deduction had gone away and we saw an increase in the tax rate back to 39.6 for business for individuals, which is what it was scheduled, then that delta between flow-through taxation at a single level versus double taxation completely goes away. Now, with that, with the Tax Cuts and Jobs Act, a lot of people asked a reasonable question: with the significant decrease from C corporation rate and the only small decrease in the individual rate, does it make more sense for me to be a C corporation? Again, this 199A deduction is what preserved that benefit of flow-through taxation. And now that we have a permanent extension of the 199A deduction, I think for most that are currently taxed as a flow-through entity, that'll continue to be the right course for them going forward. Now, Amy mentioned that there were a number of things that changed between the House bill, or what the House was talking about, and what the Senate eventually came up with and was passed into law. And one of those things with the 199A deduction, you may have heard, the House was looking at increasing the 199A deduction from 20% to 23%. That would have lowered the effective rate of tax on flow-through income by a little bit more than 1%. It would increase the benefit, the effective benefit, by about 1%. That's not what made it into the law. We have an extension of the 20% rate. The House had also talked about adding a 5% minimum deduction for specified service trades or businesses. So something that was part of the original law and is still part of the law with the permanent extension is that certain businesses, certain specified service trades or businesses, this includes doctors, lawyers, accountants, are excluded from benefiting from the 199 Cap A 20% deduction once they hit certain income phase outs. There's also W-2 and business limitations that apply to this. So if you're not paying enough wages in your business, or you don't have enough assets in service, you might be subject to limitations as well. The House bill had sought to create a minimum 5% QBI deduction even for SSTBs. That didn't make it into the final law. So we do have an extension of the 20% and a retention of the SSTB phase outs. We did have an increase in the SSTB phase outs and W-2 phase outs. that are listed on this slide as well. So it should mean that more SSTBs and other businesses that might have been limited for W-2 reasons are eligible before being subject to the full phase out. So that's going to be helpful. They also introduced, this one's a little bit interesting to me, they introduced a minimum $400 deduction. So long as you have at least $1,000 of QBI, you're going to get at least a $400 199A deduction. You know, what does that mean? If you're in the highest individual income tax rate, 37%, that $400 deduction is worth $148. You know, why they went through the ink in the paper to add this, I'm not sure, but it's there and helpful and potentially helpful. Next extension that we saw as part of this Senate bill is the extension of 100% bonus depreciation. Now, this is something that had been in the code for some time and something that's hugely helpful for taxpayers that are acquiring new assets and recovering the cost of those assets in their business. But we had seen a phase down of the bonus depreciation rules over the last few years. For 2025, as we sit today before the passing of this act, the bonus depreciation limit was set at 40%. For 2024, it was 60. For 23, it was 80. And we were going to continue to see a phase down going forward to 20 and then eventually 0, or bonus depreciation was scheduled to go away. The bill as passed includes a permanent extension of 100% bonus depreciation with retroactive application back to January 19. That's the inauguration date. So for 2025, we have kind of a bifurcated year. For your assets that might have been placed in service prior to January 19th, you will not be eligible for 100% bonus depreciation. The 40% will still be in effect, but for the remainder of the year, for 19, after January 19th and the remainder of the year, and then now made permanent, we have 100% bonus depreciation. Again, this is really beneficial for businesses that acquire personal property to have this flexibility to be able to immediately recover those costs. And so I would suggest if you haven't re-looked at your tax projections for 2025, now's a good time to do that, because if you were planning on only being able to recover 40% of your cost through bonus depreciation for assets placed in service, now with the 100%, that might decrease what you're looking at as a tax bill for 2025. And the way to immediately benefit from that versus waiting until April is that you might be able to start reducing your estimated tax payments going forward because of the 100% bonus depreciation. For our equipment dealers and auto dealers, this is also a great provision because it helps incentivize customers for acquiring those assets. For people that are in the real estate business, this is helpful as well. Now, generally, the general rule is for commercial buildings, the depreciable life of a commercial building is somewhat restrictive. You only get to recover those costs over 39 years. For non-commercial buildings or for residential property, that recovery period is a little bit shorter, but still long at 27.5%. And so something that's popular with owners of real estate, whether it's the real estate that you use in your business or if you're a lessor of real estate, is obtaining a cost segregation study that allows you to bifurcate the cost of your building between what is required to be capitalized at 39 or 27.5, the real property piece, and pieces that can be pulled out and treated as personal property, furniture and fixtures and other things that are associated with the building that will now be subject for, or now be eligible for 100% bonus depreciation. So for landlords and holders of real property, this bonus depreciation extension is a great benefit as well. We also see an extension of the limits for Section 179 expensing. So this is kind of like brother, sister with bonus depreciation. While we lost the benefit of 100% bonus depreciation, many taxpayers were able to still benefit from full expensing for a lot of the equipment they acquired through Section 179. But 179 is generally more restrictive than bonus depreciation. It's limited to your business income. So one, you have to have business income. There's certain types of income that don't qualify. And two, you have to have income in general. So if you can't create a loss with Section 179, it's only available up to the amount of income that you have in that business. But they did extend the expensing limit, almost doubled it. I think for 2024, it was about 1.3 million was the expensing limit for 179. We now have an inflation indexed 179 limit of 2.5 million, so you can expense up to 2.5 million. There's also a phase out that exists with 179 property. So if you're putting in property in service, now the new limit is in excess of $4 million. You start to lose the benefit of Section 179 dollar for dollar in excess of that. So you eventually phase out of being able to use 179. With the reintroduction of 100% bonus depreciation, probably less situations where 179 is going to be necessary, but there are still some complicated distinctions between what can qualify for 179 and what can qualify for for bonus depreciation. So it still makes sense to revisit those tax projections, because even if you're if you might have benefited from some 179, you might have not been getting it all, and now bonus depreciation can help you with that as well. There's also state tax differences as it relates to bonus depreciation and 179. Most states have their own rules when it comes to this accelerated depreciation, and they either do or don't follow bonus and 179. A lot of them don't, but there might be reasons if they're following 179 and not bonus, where taking 179 is the better option than bonus. So good to see that we have a significant increase in extension of the ability for businesses to recover costs using Section 179 as well. Now, this next slide is something I want to take a bit of time on. Research and development expenses under the new law are once again eligible for full expensing starting with tax years beginning in 2025. And so one of the things that was part of the Tax Cuts and Jobs Act was a requirement that businesses capitalize and amortize their Section 174 research and development costs. If they're domestic costs, they were required to be amortized over 5 years. And if it's R&D that's occurring outside the United States, it's a 15-year amortization period. This was an incredibly unpopular provision of the 2017 Act that didn't take effect until 2022. In that time in between, that 4 or 5 years in between, it was just generally accepted that we'll pass some other law that'll make sure that this never takes effect, because who would want to penalize companies in the United States that are spending money on research and development? It was unpopular on both sides of the aisle. However, we couldn't get anything passed, and for the last few years, we've been dealing with capitalizing R&D costs, domestic R&D costs, and amortizing them over 5 years for taxpayers. It's been hugely impactful and detrimental and cost businesses a lot of money. We now finally have a fix for Section 174 research and development expenses, which says that starting with the 2025 tax year, you're no longer required to capitalize and amortize your domestic 174 research and development expenses. The non-domestic, that research and development occurring outside the United States, is still subject to capitalization and is still subject to a 15-year recovery period. But the domestic, starting with the 2025 tax year, will now be deductible. In addition to making the change prospectively, there's also some options for all taxpayers to recover the costs of their unamortized 174 domestic 174 research and development expenses from the 22, 23, and 24 tax year. So something that's available to all taxpayers, regardless of size, is that your unamortized costs from 22, 23, and 24 can now be expensed on your 2025 tax return. Or you can elect to split that deduction between your 25 and your 26 tax year. So all taxpayers are now going to have the option, and not required, you can continue to amortize if you want, to accelerate the deduction for the unamortized piece of your domestic R&D into 25 or into 25 and 26. In addition to that option, small taxpayers, which are generally defined in 2025 as those with average annual revenue of $31 million or less. So you look at the prior 3 years, if you've got 31 million or less of average annual revenue, then you're a small taxpayer. You are eligible to go back to make an election and amend your tax returns from 22, 23, and 24 and ask for a refund. So there's lots of planning that goes into this consideration, and every taxpayer who has capitalized 174 expenses needs to look at what these new rules mean for them. If you're a small taxpayer, you have the option to deduct in 25 or 25 and 26, but you also have the option to amend and go back. And some of the things that we look at are, you're going to get the benefit at some point, but how fast are you going to get it, and how big of a benefit are you going to get? The how big of a benefit you're going to get depends on your tax rate year by year, and that deduction on one of the prior years might be at a higher tax rate than it would be in a year going forward if you have lower income. So it might be better to amend. And you also, if you're not going to have as much income or be able to use all of the deduction in 25 or 25 and 26, you might want to amend those returns and ask for refunds if that's a way to get money back quicker. So we're already helping a number of our clients, and we'd be happy to talk to you about your options if you have capitalized Section 174 expenses. The business interest limitation was something that was brand new with the Tax Cuts and Jobs Act, and it wasn't scheduled to go away, but the way that it was calculated changed over time. And now we have a return, a permanent return to the way that it was calculated when the Tax Cuts and Jobs Act first was passed. So historically, there are very few limitations on businesses, the ability to deduct interest on money it borrows in the performance or in the furtherance of its business. There were very few tax limitations on being able to deduct that interest. If you borrow money and you use that money in your business, the interest was deductible. Section 163J was changed under the Tax Cuts and Jobs Act to provide or to include a 30% adjusted taxable income limitation on your ability to deduct interest expense. So we had a calculation of what is your adjusted taxable income. You multiply that by 30%. If your interest expense is in excess of that, then you have to carry forward that interest expense. You don't get to deduct it in that tax year. That adjusted taxable income, the original calculation allowed you to add back certain things, your interest, your taxes, your depreciation, and your amortization. It's more of an EBITDA calculation before you got to the 30%. Over time, the Tax Cuts and Jobs Act phased out the rule that allowed you to add back depreciation and amortization to that calculation. It meant that more taxpayers were subject to that limitation. We now have depreciation and amortization back. We also had an expansion of the floor plan interest exception. So auto and equipment dealers were accepted from this limitation on interest on their floor plan. They've now expanded that definition of floor plan to include trailers and campers. A few things I want to move through here quickly in our time left. Special depreciation for production property. We've been getting a lot of questions about this. This is something that's completely brand new. As I mentioned before, when you're building a commercial building, the life on the building itself, the recovery life on the building itself is 39 years, somewhat restricted. It takes you a long time to recover the cost of the building. That can be benefited oftentimes with a cost segregation study to identify pieces of that cost that are not real property, that are personal property, might be available for more accelerated depreciation. This new rule, something that's brand new as part of the Act, is an allowance for 100% deduction for qualified non-residential manufacturing property. And what this means is buildings that are placed in service between 2025 and 2030, so long as they were construction began in 2029, are going to be eligible for 100% bonus depreciation. You can imagine why they passed this. This was something that kind of goes along with the tariffs, trying to incentivize businesses to manufacture in the United States. So expansion or construction of new production property is now going to be eligible for 100% bonus depreciation. There's a couple important definitions that are going to be part of this consideration. Whether or not you actually have qualified production property and are doing manufacturing is going to be important. And then bifurcating those costs, because there's still pieces of the building that are likely not eligible for 100% bonus depreciation. That would be things like the administrative areas of the building that are required to be cut off. And so I'd still anticipate for a lot of these new buildings or building expansions, we're going to be looking at cost segregation studies just to make sure we've got everything right. But an incredible building or incredible benefit for the manufacturers. Employer-provided child care credit. So this is a credit for investments in child care. That rate increased from 25% to 40%. Opportunity zones. I want to spend a little bit of time on this one as well. This was something that was new as part of the 2017 Tax Cuts and Jobs Act. What it does is it allows for certain benefits for taxpayers who invest in opportunity zone funds or businesses. Opportunity zones were state designated areas. It was a federal program. They allowed the states to designate certain areas that qualified as opportunity zones. If taxpayers invested in a business or a fund that operated with inside that opportunity zone, there was a couple significant tax benefits. One, the taxpayer can defer capital gains for dollar equal to the amount of that investment. So to make an example, if I had $100,000 of capital gains on my in my income for that year, I could put a $100,000 investment into an opportunity zone fund and defer that gain. The original deferral period under the Tax Cuts and Jobs Act was 2026. It was a line in the sand that was 2026. And so depending on when you made that investment, you had a longer or shorter deferral period until 2026. In addition to that, the longer you held that investment, if you did it initially, you got a basis increase of 15%, that dropped down to 10%, then eventually was zero. So initial investments, I wasn't only getting to defer my $100,000 of gain, eventually eliminated 15% of it, or $15,000, and only paid tax on $85,000. The second benefit of an opportunity zone fund investment is that if I hold on to that investment, that $100,000 investment in the fund or the business for 10 years or more, and I eventually sell that business or that fund, the appreciation over the $100,000 is not taxed. I can make an election to increase my basis and not be subject to tax. The new bill extends the benefit of opportunity zone funds, and it does it in a very interesting way. It's permanently extended, and the way they added this deferral benefit is it's a rolling 5-year deferral. So these opportunity zone funds are going to be back for 2027. If I make an opportunity zone fund in 2027 and defer some other capital gain that I have, that capital gain deferral, in my example, $100,000, would be deferred for 5 years. If I hold it for the whole 5 years, I get to increase my basis by 10% and only pay tax on $90,000, not $100,000. And then that permanent escape of the appreciation, if I keep it for 10 years, is in place as well. So we've helped clients that started business in opportunity zones. We've also consulted with a lot of clients who have made investments into these funds. With this permanency now of opportunity zones, I think this is going to be something that's much more common, and something that everybody's got to consider anytime that they have significant capital gains for a year. Qualified small business stock, this is for C corporations that are under a certain size. If you hold them for more than 5 years and then sell the stock, there's no gain on the sale of that stock. A couple changes to that rule. The exemption, if you hold it for between 4 and 5 years, is now 75%. They've also increased the benefit. The maximum that you could exclude was 10 million. Now it's 15 million. And that small business designation increased from 50 million to 75 million. Excess business losses, something that was new as part of the Tax Cuts and Jobs Act and is extended permanently, is that you're limited on the amount of business losses that you can take against non-business income, which includes your investment income and your W-2 income. That was made permanent as well. Quickly, some clean energy incentives. Really what this is saying is most of these things are going away, much of them starting in 2026. Some you can see are pushed out a couple more years, but some common ones we've seen solar credits, clean vehicle credits, the electric vehicle credits. Have a lot of contractors that are eligible for the 179 Cap D commercial building and 45L new energy efficient home credit. Those are going away under the new law. And I think the last thing I wanted to mention, there's a few administrative provisions that assist taxpayers, make things a little bit easier on taxpayers. The one I wanted to point out, the 1099 threshold for 2026 is going to increase from $600 per recipient to $2,000 per recipient, and that becomes indexed for inflation in 2027 in years going forward. So with that, I'm going to turn it over to Amy, and Amy, I'll start looking at some of the questions so we can answer what we can.
Thank you, Ben. And so before we do that, I do want to bring up that we are offering a legislative impact assessment. This is for businesses and for individuals to basically go through and identify how this bill is going to impact either your business or your personal situation. There is a lot of information in this bill, and Ben and I really talked about just the tip of the iceberg. There are a lot of different changes that could impact your tax situation, and we want to be there to help you through that. So you will be receiving an email after this presentation that will give you additional information on this assessment. And please reach out either via the assessment page or to your HBK tax app. Now, with that, Wayne, I believe that you were monitoring questions.
I've got them up here, Amy, and I can start answering some the best that I can here, Perfect. If that's all right. Yeah. So we've had a couple questions about the new $1,000 and $2,000 charitable deduction, that above the line deduction. That takes effect in 2026. That's my understanding. This is something that's going to be hugely helpful, as Amy mentioned. We saw it before at lower levels at $300 and $600. With the increase to the standard deduction, there's far fewer taxpayers that are itemizing, and so they're not getting the benefit of their charitable deductions. This new $1,000 and $2,000 above the line will allow you to benefit both from the standard deduction and your charitable contributions. There's a question about tips, the exclusion from tax on tips. My understanding is, yes, that is just from income tax. There's no change to the FICA withholding related to that. Somebody asked, is the car loan interest deduction above the line, so you don't need to itemize?
It is above the line.
Thank
it's
you.
not an itemized deduction. It's above the line. So it's not going to be subject to the itemized deduction limitation.
Another question, looking for clarity on the overtime relief. If your base pay exceeds $150, you do not qualify. That $150,000 limitation is an AGI limitation. So other sources of income could affect your ability to claim that deduction on your personal return. We've had a lot of questions on the overtime relief, and my understanding is that it's really only available to your traditional hourly employees or your acquired hourly employees. So non-exempt salaried employees under federal employment law are not eligible for this deduction. It's your, excuse me, did I say non? It's your non-exempt employees that are required to be paid overtime under your federal law that are eligible for this deduction. Exempt employees would not. That's my understanding. Amy, I don't know, this one says, can grandparents contribute to a saving account, $1,000 to a Trump saving account and receive the credit?
Yeah, so the credit is a per child credit. So who contributes that and gets the credit isn't really specified. It's a qualified taxpayer, essentially, that sets this up for the child. So it could be the grandparent claims that $1,000 credit for the grandchild, but then the parent won't be able to take the $1,000 credit. So there probably has to be some coordination within a family as to who is going to take that credit, but it is per child, not necessarily per taxpayer.
There's a few questions related to bonus depreciation. One says, does bonus depreciation cover build out of retail stores? And so there's a category of property called qualified improvement property. So interior non-structural improvements to existing buildings fall within this qualified improvement property category, which is 15-year property that is eligible for bonus depreciation. And now that we have that 100% bonus depreciation, great benefit there. Someone asked, does bonus depreciation basically negate the need to do a 1031 exchange? So a 1031 exchange allows a taxpayer to defer the gain on the sale of real property that's held for investment or used in a trade or business. And I think the question would be, so if on the flip side, I get bonus depreciation on what I buy, why would I need to do a 1031? Well, the bonus depreciation doesn't apply to investment or business property to the building itself. So you'd either still be dealing with 39-year recovery period for the cost of the building, or 27.5, depending on whether it's commercial or residential property. So the 1031s would still be beneficial, although there's probably is some personal property you can carve out to deduct currently.
So it looks like we're right at 12 o'clock here. Ben, I don't know, I'm seeing additional questions coming in here, but I don't want to extend this out too long.